Awesome, you guys. Great to see you again. I want to introduce today Vinny and Zach. They're from Dovetail Capital. We're going to talk to them a little bit about some last minute deductions as we're rolling into, gosh, April 15th is coming right up, about a month away or so. And then we've got
hmm
only about 5 days before we end up with some corporate and partnership tax returns that are due. So just some last minute deductions that'll take you through April 15th and maybe even a little beyond that if you're a business. So let's get right into it. Let me pull my slides in, share something, and we'll get started with the conversation, guys. So, title of it, I love it. It's not too late to reduce your 2025 tax liability even in 2026. So, really, some last minute contributions you can make and strategic deductions that really aren't even necessarily all retirement um, related. There's a few others we threw in there just to keep things spicy. So, let's get started. The sprint towards April, securing your future. So let's talk a little bit, you guys, about traditional IRAs. Everybody's heard about traditional IRAs. Let's talk about what the deductions are and some of the non-deductible options that are out there too. You want to kick us off, Vinny?
Yeah, and thanks for having us on for this, Tracy. Again, I think this is a really fun time of year to be intentional about where you're putting some extra money that you might have left over from good cash flow in 2025. So traditional IRA, that is one of the areas that Zach and I first start to think about of making sure that we fund if we can, and really Roth areas as well going within this too. So April 15th is the deadline to make contributions to those accounts for 2025. And just to give a quick refresher, uh, traditional IRAs, that's going to be funded with pre-tax money. So that's where you're going to be getting that actual deduction, saving on your tax liability there, where a Roth IRA is funded with after-tax money. No deduction, no tax savings in this year, but you're at least getting the benefit of tax-free growth, right? And the limits there,
Except
whether
if you have, except if you're a participant of a plan at work, then it might not be deductible. Sorry to cut you off. I wanted to put that asterisk in there before you
no,
blew
it's a
on
really
by
good
it.
point. There are limits of what you can put into these accounts. 7,000 for 2025 is a regular contribution. 75, or sorry, 8,000 additional $1,000. So 8,000 total if you're older than age 50. A lot of people have access to put money into these accounts. Like Zach is saying, though, it's a little more nuanced. Where if you have an employer place or an employer retirement plan in place, or even your spouse has a retirement plan in place, then you're probably going to be limited, if not fully restricted, from making deductible contributions to a traditional IRA. That doesn't mean you can't still take some advantage. And we talked about the Roth IRA being very important at that stage, where we might make non-deductible contributions to the traditional IRA and immediately convert that over to a Roth IRA. You see
There's a lot
that?
of things, a lot of strategy around IRAs. They're just not
Yeah.
really straightforward anymore. I think there's so many different flavors of them. You've got a traditional IRA that everybody has heard of, and you hear it in the media all the time, especially closer to April 15th. And then you've got a non-deductible one, which you just mentioned is great if you're an employee someplace and you don't have to can't contribute traditionally to a deductible IRA. You can still do the non-deductible ones, and then there's Roths and conversions and all kinds of stuff. So the key there is just being you've got about a month or so. So get with your tax planner or perhaps even your wealth manager and start talking about these combinations and different flavors of traditional and
hmm
Roth IRAs. I think that's the point, right?
Exactly.
Lots of
Yep.
good stuff out there. And I like kind of deducting some of those IRAs or thinking about planning way in advance of April 15th. So if you're April 15th, 2026, why not make that contribution for 25 and 26 at the same time? And to kind of get ahead of it. If you can make your contribution in 26 for 26, then that money is really working for you for a whole year ahead of what you're doing for 25. And that whole year will really make a lot of difference 30 years from now when you retire, because you've got a whole year of compounding at the very beginning stages. So think about making those contributions and planning ahead, even doing your 26 ones right now. So you want
Exactly.
to talk a little bit, maybe Zach, about health savings accounts and how those sort of work, although they're strictly not retirement plans, but they kind of are when you
Yeah.
when you position them correctly.
Yeah. I mean, it's another component to consider and fit within the overall strategy, which often, is pointed at retirement in some way, shape, or form. But yeah, you can still make the contributions to an HSA. Sometimes there's logistical challenges, like if you're part of an employer-sponsored plan, or even if you're the employer and the type of plan that you sponsor only allows for salary deferrals, there's still some of those out there. And you forgot to increase your limit on your salary or your contribution rate on your salary or whatever the case, if you still got some of that limit available to make contributions, you can always open up your own individual HSA and still get those 2025 contributions in. And yeah, Tracy, you touch on a good point. Um, Later on in life, obviously the HSAs, even if you've got a lot left over and you don't have high medical expenses after the age of 65, it pretty much functions like a traditional IRA at that point, where that 10% early withdrawal penalty goes away. Or I guess for the HSA, it's not really withdrawal, it's just you can use it for things other than health insurance after the age of 65, and there's no 10% penalty. It's just taxable income like an IRA would be.
Right. So the idea
So
is really
again,
to fill
lots of
up those
nuances.
IRAs first or the 401ks first and have that HSA kind of in there too in the mix. But it's something that a lot of people don't think about funding those
Mhm.
HSAs. And instead of using those dollars, just let them grow until
Exactly.
you need them in retirement. Yeah,
Yeah. Yeah.
good idea.
And you can use
And
it
then the
for lots of
last
other
one down
things.
there, Arizona tax credits. So not really retirement stuff, but it does have the ability to lower your income taxes on the state side. So you get a
Yeah.
dollar for dollar reduction, right, in what you.
And I always think this one's interesting. We have more clients bringing it up to us than I think in the past, and I'm not sure. I've heard that Arizona is a fairly unique state where you have several dollar for dollar tax credits available for you that you can stack, whether it's a qualified charitable organization, qualified foster care organization. There's a few others there where if you have to pay your tax anyways to the state, and if you're someone that kind of grumbles about paying that state tax, might as well make a contribution to an area that you really, might favor more, direct your dollars that you're gonna have to pay anyways and get that credit. So I always thought it's always interesting to bring up around this time,
Yeah, it's
where
really
you,
diverting
you,
those. Yeah,
oh,
I'm
yeah,
sorry. It's really diverting those monies to a charity or some other organization you'd like to see get the money.
exactly. And most people, if they want to make a deduction or a contribution, excuse me, to any charity, December 31st is the deadline to make it so you can have a deduction on federal taxes, but that's also only if you itemize. So this is a credit that's available even if you take the standard deduction and you have until April 15th to go off of, which is really nice.
Yeah, I mean, you get a lot. There's even a military one that's $400 if you want to do a military family deduction. There's private school that's worth about 4 grand or so. So you have any questions about that, just jump on the Arizona Department of Revenue website and just put individual tax credits and they'll all pop up there. The real thing that's really important is making sure you're making those contributions to qualified organizations that have been qualified by the state. So, and they're pretty much all in state. Every year I have people come to me and they say, man, I made all these contributions to this thing in Iowa where I used to go to school, and can I do that? No, you can't do that. It's got to be in-state stuff, and it's got to be approved by Arizona. So just be mindful of that one.
Nice to give the money, but it'd be good to get the credit if you could as well.
It is, yeah. Heck yeah. Heck
I
yeah.
think you should just give it to the government. I mean, they always act in your best interest.
Exactly. They need the
I'm
funds.
sorry, Zach. I'm sure I didn't hear that right. All right, so the next area that we want to get through is we're going to talk about maybe leveling up some other areas in retirement planning beyond the IRAs, and really we get some extended due dates here if you're looking towards what we've got and how the slider works. We've got self-employed pension plans that are all the way to October 15th for particularly Schedule C people, and then we've got the solo 401k and the 401k plans for new plans and then existing plans. So who wants to kick off that and kind of split it up? Vinny, why don't you start with the self-employed set plans for us?
But I'll kind of give an overview on all of them really quick here, at least what we think about. But you're right, after April 15th, April 15th is that rush for any IRA contributions, what might make sense there, any tax credits we want to go off of. But we have a little bit of breathing room if you go off the extension deadline for some of these lists here in the slide. These are going to be more based on the employer side. So if you're a business owner, and you have a solo 401k or a SEP IRA, or really just looking to even open up a brand new account and put some more money aside for the 2025 tax year, these are your best bets to do so at this stage. And really, again, when we think about contributions to a retirement account, it's either coming from that employee side, a salary deferral, you're reducing FICA wages maybe. But the employer side is all we can really be doing at this stage. And it is just reducing federal and state income tax. A good way to put a chunk aside, but there are nuances depending on what your income structure is and how much you actually bring in. You're going to be paying usually about 20 to 25% is your limit of what you can put aside for these different accounts. But they're all fairly straightforward, usually pretty easy to set up on the solo level. You do want to be careful if you have employees, then the rules change a little bit more for you, but there are still options available at that stage too.
So
If you have,
solo means solo. You don't only can have you and I think a spouse, right?
correct,
So
yeah,
just be careful. Yeah, be careful of that. We did have that situation last year when somebody had a solo and they thought they could roll with having employees, and it didn't really work out very well.
exactly. Right, right. Yeah. And this is a really fun time right now. We're going through what's called 5,500 filing for a lot of 401ks. Some solo ones do not need to do this. A lot of group 401k plans. So if you have employees, if you have a 401k, you're usually going through this process of recording and sending information over to the Department of Labor. And this is a great time to ask your TPA to run illustrations, estimates of what would profit sharing options look like, what's a way to maximize the benefit for you or your spouse or other classifications of people within your organization. Again, usually you need to spread that money around to all employees, but again, it is still something to ask about because you have some time to do so.
Yeah,
Zach, any?
and the good news here is that you have until April 15th or even October 15th, depending on which plan you're selecting, what your planning deadline is. So yeah, like that stuff. All right, let's roll into the next slide here. We've got some other kind of, we call them elite toolkits, but just some other planning ideas that we've got floating around out there. A big one, everybody's heard of this one, I'm sure, is that whole backdoor Roth situation. What is a backdoor Roth, Zach?
Yeah, so
I mean, is there a front door Roth?
there is a front door for
A
people
side door
who
Roth, a garage
there's a
door Roth.
side door.
How many doors do we have in a Roth anyway?
I
No,
mean,
I'm
I
sorry.
would
Go ahead.
consider the 401k one the garage door, the mega back
Oh
door,
yeah, you got the mega back
because
door, the garage door. Yeah.
the income limits are higher. But yeah, so to understand a Roth conversion, just a really quick 30,000 foot view. Traditional IRA, you put in pre-tax money, it grows tax deferred. In retirement, your tax on every dollar you pull out. Roth IRAs, you put in after-tax dollars, so you've already paid income taxes on the money that you're making contributions with. It grows tax deferred, but in retirement, when you pull that money out, it's completely tax-free. So a conversion is a fancy way of saying you're transferring money from a traditional IRA into a Roth IRA. And when you do that, you pay taxes on the dollar amount that you convert or that you transfer. So if you transfer $10,000 from a traditional to a Roth, then you get a 1099 for $10,000 in that year. So what happens is there's an income limit. So if you make too much money, you can't walk through the front door of the Roth IRA. You have to take the back door, which is making a contribution to a traditional IRA and pretty much immediately transferring it into a Roth. You're allowed to, there's no income limits on transferring from a traditional to a Roth. It's kind of a silly thing, but there's
Is
there's
that
a
what
lot
they
of
call a
nuances to
loophole,
it.
Zach? Everybody wants the loophole. Is this a
It's a
loophole?
loophole.
It's a loophole.
This is one of those things where there's so many nuances. I have to say this so many times. Talk to your advisor and your tax person about this before you do it, because I've seen it go wrong. If you've already have an established traditional IRA, um, then you can't just simply make a non-deductible contribution to a traditional and then transfer that portion out. And I'll get too far into the weeds if I go down that rabbit hole. So there's nuances to it, but if you don't have any IRAs and you already make too much money, or if you are covered by a plan at work and you can't make deductible contributions to a traditional IRA, then the back door makes a lot of sense.
Okay, so big picture then. If I've got some extra money at the end of the year, I've got a 401k at work, maybe think about a backdoor Roth IRA and talk to somebody that's either your tax person or maybe your wealth advisor to think about maybe that might be a possibility for you. And they'll run through the scenarios, get the rest of the data and help you make that decision, right?
Yeah, they'll go into the weeds with you.
Yeah.
Yeah.
And
And
then
guys, I mean, this is how we most work with people anyways, is, around this time of year, if we're looking at it, they have extra cash on hand, past what they need in savings, past what they need for cash flow for the business, having surplus. The best thing that we can do is
Give the
figure
rest
out
to
what
me.
that surplus is and figure out the best ways to start allocating it. So, not saying all this for people to retain on their own, but, really get in gear of, okay, we should talk about this and see, is there a more effective way to be putting some money aside right now at this stage in the year?
yeah, okay. All righty. So cash balance and simple plans. Those are two different animals. Let's tackle simple first because it sounds like it's easier.
It sounds easier, but it's weird in the administrative side, where
It is.
it's honestly not as
Simple
simple.
is a simple IRA. I mean, that's another IRA. Maybe we should put it up on the other slide, but simple is an IRA, technically. It's a super.
Yeah, and it's honestly a really great starter plan for someone who has employees, does not want the administrative workload of a full 401k, and but still wants the flexibility of putting money aside for themselves and for their employees.
Yeah,
So
that's what
they're
we started with, Vinny. That's what we started with at our firm. We started with a simple 401k, a
Yeah,
simple
we did.
IRA to begin with, and
we did
then
exactly.
migrated it into a 401k. It's kind of like training wheels a little bit. Gets it started, get a good deduction.
I think it gets a lot of people used to the fact that they are giving to more employees, but then once you go to the 401k, as you know, there's a lot more of an administrative burden, which again, there's
A lot
people
more
there that
cost. Yeah. A lot.
cash balance plans are a whole different animal, and you're appropriately putting in the high earner strategy. Cash balance plans, we see it for business owners who are just absolutely killing it cash flow wise, and they have a ton of surplus. And this is a stage where they're maxing out their 401ks entirely. They're putting the money aside into Roth areas for the backdoor conversion method that we just talked about. Now we're looking at uh, essentially a higher amount you can start stocking away on an annual basis. And that is what a cash balance plan is. It's a defined benefit plan that you can contribute to, but you have to do it on an annual frequency. And you are really restrained where you can't just say, I want the flexibility to do it year in and then pause for the next year and then start it back up. You're committing to an annual funding target for you and for your employees. These are plans that can be tailored to benefit you as an owner more and older employees more. So again, the administrative work is more in depth, but when we're looking at the stage of putting away a couple 100,000 per year, it really starts to make sense for the tax efficiency and the benefit that it provides.
So it really makes sense when we fill those other buckets. We've got the backdoor Roth filled up, we've got the regular IRAs filled up, the 401ks filled up, we've got enough savings sitting around that we really can start thinking about these cash balance accounts. The cash balance, as you said, defined benefit. So we got to do actuarial studies and all that stuff. So it's a pain in the butt. But really, you can put away a lot of money in the right circumstances. They're perfect. You got an older couple people in the business earning a lot of money, and maybe everybody else is kind of younger in the business because it's going to be
Yeah,
based on age, and it can really benefit the business owner. Yeah, that's
exactly.
awesome. Yeah,
Exactly.
cool. The next thing we're going to talk a little bit about Archer MSAs. You guys want to handle that? You want me to talk a little bit about it?
Yeah,
Just
it's interesting. We haven't seen a lot of Arch MSAs
yeah.
be as popular for a while because of the benefits of HSAs. I think Arch MSAs came out more before HSAs had really the flexibility that they did. Is that right?
Yeah, or FSAs are another plan that you can think about. When to get an HSA, and I love HSAs. We've got an HSA. We have clients that have a lot of them as well. And but you've got to have a high deductible health plan to get there. So a special kind of a healthcare insurance plan. MSAs and FSAs, you don't need that kind of a plan. You can have a PPO. You can have one of these payments where you usually go into the doctor and you pay a deductible when you walk in. You pay your 20 bucks or 50 bucks or whatever it is. That's how you can tell that you've got one of those qualifying plans. Then you can set money aside and put it into an MSA account. Anyway, you can make contributions to that before April 15th as well, if you're so inclined to do that. There are different provisions, different amounts. I think for single, and I can look it up if somebody really wants to know, but I think it's about 4,800 bucks, and married, I think it's right around 8,000, maybe $8,400, something like that.
Yeah, I think it's
Yeah, sounds right.
85.50 for a family.
85.50. Okay, cool. Thank you for looking that up. Appreciate that. And then who wants to handle the spousal IRA? Zach, you want to talk a little bit about the spousal IRA?
Sure.
Actually, I'll talk about the spouse later.
Oh no, I can't get
Yeah,
Zach to say anything. Can we get Zach in here? I mean,
yeah,
for
Zach,
I mean,
God's
I
sake, give
am,
Zach a
talk about
chance
the
to
ESA.
speak.
There's so much to say. You
Any-
know that.
yeah, Vinny does have a lot of words. Some of them are useful, but not usually. The spousal IRA. So if you have a stay-at-home spouse who doesn't have employment income or taxable income, because one of the rules on making contributions to any type of IRA is you have to have earned income, and earned income usually through employment. It doesn't count like a distribution from an IRA doesn't count towards having income. Um, but the you can use your spouse's income to qualify to make contributions into a non-working spouse's IRA in the name of the non-working spouse. So, anyways, it effectively doubles the amount that you can deduct if you're eligible to make deductible contributions, because now instead of only contributing to one account, you can contribute to two. Sometimes it's even higher if your non-working spouse is above age 50, then you get the catch up as well. Um, but yeah, it's basically the same thing as contributing to a regular IRA. It's just in the name of your spouse because you can only have
Okay,
one owner of an account. Um,
cool. Can you flip those into a non-deductible and then flip them into a Roth too and use the backdoor, kind of combine that, Zach?
Yep, you can use the back door if the front door is locked, and the
All right.
same thing there.
Awesome.
And
Plenty
the
front.
Coverdales, are the Coverdales deductible in Arizona? Or is that just
There is a
529s?
small deduction in Arizona in the Coverdales. Yeah.
Yeah, for that
It's
pesky two and a
similar to
half percent
529.
income
Yeah,
tax rate.
529 plan. Yep.
Yeah.
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 Those are great. You know, the one thing that's not on our list today, but we are going to do, I think, another short webinar on that is those Trump accounts. Everybody's hearing about the Trump accounts right now,
Hmm.
and they're still kind of being worked through. I know the AICPA just, got some new information from the IRS, and the IRS just released some stuff. So we'll be talking about those Trump accounts, but those are terrific too for the kids, and you don't need to necessarily have income in order to make contributions. Parents can
Yeah,
make contributions, uncles, aunts. Zach, if you want to make some contributions to my kids, that'd be great. Vinny, you can make it to my
would love
grandkids, and
to.
we'll be all set. All right.
We just make contributions to each other's kids.
That's it. I think we could do that. That's what
Make
they
a
used to do with tax credits, but we're not going to talk about that right now. All right. So, final slide, just to kind of let you guys know a little bit about how to reach us if you want more information. I'm Tracy Cobb at Cobb CPA, and then we've got our tax manager, Christy CPA. She's also out here, and this has been Vince and Zach from Dovetail Capital. Appreciate your time today. Final words, guys.
Thanks for having us on. Sorry that you had to listen to Vinny.
Yeah, it's been
Thanks,
fun.
guys. This is a
Go
ton
ahead.
of fun. I got some at my front door. Another front door
That
joke.
was painful. That was
All
painful.
right, guys. What's really going to be important, I know we talked about a lot of strategies today, so I need to put this in here. Really check in with your tax advisor and check in with your wealth advisor to make sure which strategy might fit for you. This is really just for education purposes, and we're just trying to make increase some awareness around those deductions that still can be made before April 15th and well beyond if you've got a business. So some pretty cool stuff out there. If you have any questions, just reach out. Otherwise, we'll see you on the next one. Thank you very much.
Thanks.